I want to finish chapter 9 on mutual fund fees. And I can't remember exactly where I left off last Wednesday because those notes are at my office and I am at home. But I'm fairly certain I had just started talking about hidden transaction costs. These are costs that the mutual fund has to pay that are not explicitly stated in the prospectus or on Morningstar. Remember, the mutual fund must report their annual operating expense fee as a percentage of assets, and they do that. You can find that on the first page in Morningstar. But that number doesn't include these hidden transaction costs. So the first one that I believe I talked about in class last Wednesday is the commission that the mutual fund has to pay its brokerage firm anytime the mutual fund wants to make a trade. So if I have a small cap fund that owns shares of Globalscape and it wants to sell those shares of Globalscape, it's going to have to pay its brokerage firm a commission. There's no way we can know exactly what total commissions the fund pays in any given year, but we do know the more trades they make, the more commission they'll pay. So all we can do is examine the turnover ratio, which is reported on Morningstar. Again, the higher the turnover ratio, the more commissions they'll pay. And that's about all we can tell. We do know that index funds have lower turnovers than actively managed funds, so they should pay lower commissions. The second hidden transaction cost is called spread costs. Basically, anytime a stock is traded, and in this particular case I'm looking at Green Mountain Coffee Roasters, they make those Keurig cups and machines that are apparently really popular. But if I look right here at the bid and ask prices, you'll notice that they're not the same. The bid price is the price that someone is willing, in this particular case, this trades on the NASDAQ. So basically, there are individuals who work as dealers dealing in shares of Green Mountain Coffee Roaster stock. And so for this particular stock, there is a dealer out there willing to buy 100 shares of Green Mountain stock for $117.90 a share. That is the best buy price that there is right at this moment. There is another dealer, or maybe even the same dealer, we can't tell from this information, who is willing to sell. They're asking you to pay $118 and a penny per share for 100 shares. So there are only 100 shares being willing to be sold to you for $118 and a penny. And the way the dealers make their profits is that difference between the bid and ask price. That difference, which is 11 cents, $118 and a penny minus $117.90. That 11 cents is called a spread. So this particular dealer could buy the shares from you for $117.90, turn around and sell them to you for $118 and a penny. They would make an immediate profit of 11 cents a share because of that spread. The higher the spread, the more expensive that is for us as investors. I chose Green Mountain Coffee Roasters because they have a pretty decent spread. If you look at other more popular companies like Microsoft, they might only have a penny spread. But again, this is the best bid price and the best ask price. So if I wanted to, as a mutual fund, sell 1,000 shares of Green Mountain Coffee Roasters, I could only sell them for $117.90. I could only sell 100 of them for $117.90. The other 900 are going to be sold at prices that are lower than $117.90. The quote system is only required to report the best bid and the best ask price. So And I can tell there are only 100 shares that are willing to be traded at those prices. So I know if I want to sell 1,000, the other 900 are going to take place at prices worse than this one. Now, it's not always 100. If I were to choose another company, let's say Microsoft, you can tell there are much bigger numbers of shares that are willing to be traded at the bid and ask price. And you can see that it is just a penny spread for Microsoft. But anyway, because I might only make as an individual, I might only trade 100 shares of Microsoft, then this trade amount meets my requirements. I could sell all my shares for this $37.43. But if a mutual fund is they usually trade in much bigger volume, so they might want to sell 1,000 or 10,000 shares of Microsoft, so they could only sell half of them at this price, and the other half will occur at worse prices. So the spread cost, I'm just going to put as the difference between the bid and ask prices. I'll actually put best bid and best ask prices that exist. The third hidden transaction cost is called the market impact price. Or they actually call it the market impact cost in the book. So let's say that I've got, and I've actually already alluded to it, but let's say I'm trying to sell 50,000 shares. I've got, Word is automatically numbering these. I don't necessarily want it to. And let's say if Microsoft, I'm just going to make up numbers for this. I'm not going to use the numbers that existed on that quote that I looked up a moment ago. And so I go and I look and I discover that the best bid price is $35.90, and there are 2,100 shares that are being offered at that price. I am trying to sell 50,000 shares, so the price that I would receive is the bid price. The dealer is willing to bid or pay $35.90 a share, but only for 2,100 shares. So I decide to actually initiate my transaction. So the first 2,100 shares would sell for about $35.90. But after that, the prices get worse. Because I am selling, the prices that I would receive would drop. Basically, there's an extra supply of 2,100 shares that this dealer has now. But I'm trying to sell some more. I want to sell a total of 50,000. So maybe another dealer, once I've executed this transaction, that's the best deal out there, I go down to the next best deal that exists. And maybe there's a second dealer who's willing to purchase 5,000 shares from me, and I would be able to sell them to that dealer at a slightly lower price, let's say $35.89. But I now have only sold 7,100 shares altogether. I still have a lot more shares that I need to sell. So the third selling group, maybe it's 8,100 shares. I'm just making these numbers up. There's a dealer out there willing to buy 8,100 shares, and they would buy them from me, or I could sell them at, again, a worse price than I could before. And because I'm selling, a worse price would be a price decline. And basically what would happen is I still got a lot more shares to sell, 50,000, and I've only sold about 15,000 already. So I still have 35,000 to sell. There's probably not a dealer out there willing to buy such a huge amount, 35,000 shares. That's quite a bit. So I would have to keep going down the list of dealers and getting the best price they're willing to buy from me at, which would constantly be decreasing. So essentially, I could eventually sell all my shares, but just at a lower and lower and lower price. that's what the market impact cost is. And it works on the buy side too. If I'm trying to buy 50,000 shares of Microsoft, I would look for the cheapest purchase price, the cheapest ask price. Once I bought all I can at that cheap ask price, I have to go to the next cheapest ask price, which is going to be a little bit higher because I'm buying. But basically, because I'm trying to, our fund is trying to sell a large number of shares, it drives the selling price down, which is a bad thing. According to the textbook, and now I don't really want that header numbered, but according to Boglehead, the textbook, the average mutual fund, the average equity mutual fund, total annual fees, and this includes the management fee, the 12b-1 fee, all those fees that are listed in the prospectus, along with all those hidden transaction costs that are not listed in the prospectus, they average about 3.3% annually. That's actually quite a huge number. And I want to go through and give you an example and show you how it works against us, especially over a long time period if we're saving for retirement. So let's say we put our money into mutual fund 1, and it earns an annual rate of 10%, and it has an average annual fee of 3.3%. What I'd like to do is, let's say that we're going to invest $3,000 a year over the course of 40 years. I'd like to see what my ending value is after paying all these expenses. So we'll invest $3,000 annually over 40 years. What is our ending wealth before and after fees? I am just typing so badly. So essentially, this is trying to find the future value of an annuity. I don't have the interest factor tables in front of me right now, but what I'd do is I'd take the $3,000 and I'd multiply by the interest factor at I equal 10. Actually, not 10%. I want to use the difference between 10% and 3.3%. Unfortunately, that number wouldn't be on our interest factor tables anyway. But so basically, my after fee cost, or our return, would be 10 minus 3.3, which is what, 6.7%. So I would use 6.7% as my rate, and an N or time period of 40. And I'd look up the interest factor for the future value of an annuity, and that's either going to be the yellow or the blue sheet. I just can't remember which color is which at the moment. I'm going to do this in Excel anyway, but I'd look up that appropriate number on the interest factor table if it had gone out to 6.7. You could in reality only look it up at 6% or 7%. It doesn't have decimals between those integers. But basically, I'd like to find out how much this $3,000 saved every year, earning 6.7% for 40 years would be worth. I'm going to do that in Excel. There's just a built-in function, and I can find the future value at the 6.7% for 40 years with a $3,000 payment. I'm making the $3,000 negative because I want it to return a positive answer, and that's just the way Excel works. But if I had to pay that 3.3% fee every year, I'd end up with a little over $500,000 after saving $3,000 a year. So I forgot to copy that. I meant to just copy that and paste it here. And then what I want to do is, let's see what we would have if we didn't have to pay that 3.3% annual fee. So this time I'm going to look up the interest factor at an I of 10% and an N of 40. So this one I actually could look up on the interest factor tables. Again, it's the future value of an annuity of $1. It will be either the blue or the yellow sheet. I can't remember which one. I think it's the blue one. But again, I'll do this in Excel. So finding the future value at a 10% rate this time, not 6.7, for 40 years, saving $3,000 a year, I would have almost triple the amount of money because I didn't have to pay that 3.3% fee. It's a huge, huge difference. That is why we want to try to get our fees to be as low as possible. And the funds that have the lowest fees are index funds. That's another really good reason to invest in index funds. Even 0.5%. I'm gonna pop back over to Excel. Here's at the 10% rate. This was the 6.7% rate. I'm going to do 9.5% instead of 10%. So even a 0.5% fee is going to add up. It just won't make such a huge difference as the 3.3% fee. So instead of earning 10%, I'm going to go 9.5% for 40 years with a $3,000 annual payment. It makes a difference of almost a couple of $100,000. That's why it's so important to get your fees to be as low as possible, and the best way to do that is with index funds. Because I guess people really are interested in earning money, a lot of finance researchers have researched mutual funds and tried to figure out, is there some common characteristic that these funds exhibit that will enable us to predict which funds will do better over the long run. So they were basically looking for predictor values, variables actually, which types of common characteristics will lead to a fund performing better over the long run than other funds. So they looked at things like the Morningstar rating. I don't know if I ever actually showed you this, but if you pop over to Morningstar, and I thought I had it open, but I don't. And, oh gosh, we'll go with that VICEX fund just because it's the only ticker symbol I can remember for a fund. But Morningstar rates its funds. It gives them stars, and the best rating that you can receive is a 5-star rating. So if I go to ratings and risk, they rate them over different time periods. So over the past 3 years, this fund has gotten a 5-star rating, but for a slightly longer time period, 5 years, it's gotten only a 4-star rating, but a 5-star 10-year rating and a 5-star overall rating. So if you look at different funds, you can see anywhere from no stars to 5 stars. And I guess the idea is that the higher the number of stars, the better it should perform in the long run. But they discovered that Morningstar ratings didn't seem to accurately predict which funds were going to do better in the future. So I'm going to put not a good predictor. The second thing they looked at was past performance. The idea being, did the funds that did best last year tend to do best this year? Or did they have to do really well for the last 2 years in a row to do well this year? And they basically discovered it was not a good predictor. There was no discernible trend between past performance and future performance. And you've probably seen or heard in ads for mutual funds, it'll say past performance is not indicative of future performance or something like that. They also looked at turnover. Did funds with lower turnover tend to do better than funds with higher turnover, or vice versa? Again, they couldn't figure out any sort of trend. They looked at manager tenure. Basically, how long has the current manager been managing that particular fund? Like, for instance, with the Vanguard 500 fund, I've forgotten the guy's name. He is quite well known, and I just can't think of his name. But he managed the Vanguard 500 fund for about, I want to say, 30 years before he retired and they turned the fund over to a new person. So basically, has this fund manager had a tenure of only 2 years, or has it been a decade? That's what tenure means. How long have they worked there and as a manager? Some people are more interested in following a manager than following a particular mutual fund. So if a manager switches from managing one mutual fund and he goes to manage a different mutual fund, some people will take their money out of the old fund and move to the new fund with the new manager, just because they happen to like that particular manager. But research has found that manager tenure is not a good predictor. They've also looked at asset size. By asset size, I mean, if I go here to quote, total assets, it's just how many millions or billions of dollars does this particular fund manage. So you can see the Vice Investor Fund has about $270 million in it. So maybe the idea is that smaller funds are easier to manage. It's easier to find good investments to put that money in because it's not that much money compared to a multi-billion-dollar fund. But again, they have discovered it's not a good predictor. So there's nothing showing that smaller funds tend to outperform larger funds or vice versa. They've also looked at risk. By risk, I mean standard deviation, which I've discussed in class. Is another risk measure which I haven't actually mentioned, and it's called beta. The idea being the riskier funds should hopefully do better, but they have again discovered risk is not a good predictor. The only thing that has been found to be a good predictor is expenses. Essentially, the lower the expenses the fund has, the better it tends to do. And what type of fund tends to have low expenses? Index funds, which I know I've said probably 3 times already today. So, the conclusion from all of this research is to avoid load funds. Remember, some funds charge what they call a front-end load or a sales charge. When you first buy into shares of the fund, they'll immediately deduct a certain percentage from the amount you send them as a fee. Some funds charge what they call a back-end load or a deferred sales charge when you sell shares of the fund if you've held them for, let's say, only a year. And then other funds, even though it's not considered a load fee, other funds might charge a redemption fee, which is if you own the shares for less than, I think, 60 days, or might be 90 days. I'd have to look that up. They will charge you, but officially it's not called a load fee. The second conclusion, according to Boglehead, is to favor index funds because they have a lot of desirable characteristics. Low operating expenses and low turnover, so they won't be as negatively impacted by those spread costs or market impact costs. Always review a fund's fees. They don't actually phrase it exactly this way, but that's what they're getting at. Always review a fund's fees via the prospectus, which is available I can't seem to spell that, which is available on Morningstar. If you go to filings, once you've looked up the funds ticker, you go to filings. You can download a PDF of their prospectus right here. And it's not, if you get the summary prospectus, it's not that long, and it should list all the non-hidden fees. So just review it just to make sure you are aware of what you're buying. So know a fund's turnover, so you can have an idea of whether it's going to face a lot of hidden transaction costs. I mentioned this in an earlier chapter. Maybe it was right at the beginning of chapter 9. I can't remember. I talked about the 3 types of accounts that you can open with a brokerage firm. You can open a cash account, you can open a margin account, or you can open a wrap account. With a cash account and a margin account, they charge you a commission for every transaction that you make. With a wrap account, they just charge you an annual fee, anywhere from like 1% to 3%. That's expensive. So you would have to pay that commission yourself, or that fee yourself, plus the fees that the mutual fund charge you. So it's just adding an extra expense on top of other expenses. I would never open up a wrap account. Oh, I say never. I can't think of when I might. It's just incredibly expensive to have to deal with. And then lastly, just remember that even small costs matter, and they add up over the long run. Okay, that is it for chapter 9, and I will see y'all Friday.